here's Hewlett Packard. And you notice I'm not picking, penny stocks here. These are major stocks. I could have picked, any of the major names today, and the story is the same. If you go back this 8-year period, and by the way, if you go back in the 70s or go back in the 50s, you see the same sort of thing going on. Hewlett Packard, 65% drawdown, 8 years and counting. I want to make one other point. Be careful where you get your advice. The gurus of the day, as the market was going up, almost without exception, were telling you to buy. Buy Global Crossing, buy Enron, buy JDS Uniphase. And then when they started to fall, and I remember this distinctly, as late as the market had really fallen right in here, a lot of them said, now's the time to mortgage a house, buy all you can, it's once in a lifetime buying opportunity. And look what happened. Home Depot, same story. Disney, same story. But a lot of tradable rallies here. Tradable. Okay, here's the Dow Jones data from 65 to 83, 18 years to break even. 37% drawdown, 6 years to break even. 39% drawdown, and currently 1 year and counting, 18% down so far. Similar for S&P and NASDAQ. And you can see the NASDAQ is in the most difficult situation in terms of time to break even. So what's that all mean? Well, you got to have a winning edge. Well, regardless of your strategy, you got to have a winning edge. A winning edge is one that produces net profits or positive returns over time. So here's your portfolio equity curve. Over time it goes up. Average winning trades are higher than average losing trades. And you might have a curve that looks like this. You might have a curve that looks like that. And the point here is, even with a winning edge, you're not going to win on every trade, as you traders know. You're going to have losers, but you're going to have an edge so that over time, over a number of trades, a series of trades, you're expecting to come out ahead. And so you should have a curve that looks something like this, an equity curve. Sometimes you get into the market's not offering much, and maybe the opportunity's not that good, and your equity curve suffers a bit, but then it comes back if you have a winning edge. Now here's a simple formula, and some of you are familiar with this. If you're not, this is an important thing to understand. The profit factor, which is simply the average winning trade divided by the average losing trade times the percent of winning trades divided by the percent of losing trades. And with this formula, simple formula, you can judge how well your trading method is doing. Now here's some examples. Let's say you got a trading method A, produces average winning trade of $1,000, average losing trade of $1,000, wins half the time, loses half the time. The profit factor would be 1. 1,000 divided by 1,000, 50 divided by 50, 1. That method wouldn't make any money. It theoretically wouldn't lose any money. It would actually lose money because of transaction costs. Method B, let's say it had an average winning trade of 1,500, a losing trade of 1,000, and half the trades were winners, that would give you a profit factor of 1.5. 1,500 divided by 1,000 times 50 over 50. 1.5. That method's going to make money. And let's say you had one method C that the average winners 1,500, losers 1,000, but the percent winners are 66%. That's going to give you a profit factor of 3. And that would make a lot of money. Now, it's important to have realistic expectations when trading. Profit factor of 3 is very difficult to achieve. Very, very difficult. Anything over 1 is good. 1.5 to 2 is very good. Now the point I want to make there is, look at the 1.5 profit factor. That means half the time you're going to lose on your trade. And this is a point a lot of beginning traders in particular have a hard time with. They expect that a trading method should be able to profit most of the time, week in and week out without interruption, and that just is not the real world. And thankfully you don't need it. In fact, for years I tried to find the holy grail of trading that, you know, never lost and always won, and you had a straight line equity curve going up. And of course I found out I wasn't the only one that tried to find that. That's been going on since time began. But I finally woke up and realized there is no such thing. But thankfully, you don't need the holy grail of trading to put the odds on your side, as is made the case in this example. If you lose half the time, but the loss is lower than the average loss, lower than the average winner, you can still end up a net winner. So that tells you got to have very good risk management rules to avoid wiping out your account on those losers. Okay, here's just a visual. If you had a profit factor of 1 in green here, it would be flat. You wouldn't make any money. You wouldn't lose any money except for transaction costs. You would lose in that regard. Profit factor 1.5 is going to move up in red here. And if you had a profit factor of 3, it would really rock. But even with a profit factor of 3, you're going to have some drawdowns. You're not going to win. There's no such thing as a straight line equity curve like that. People will say, how much can you make every week? Well, that's not the right question. Some weeks you can do well and some weeks you can't. There's an ebb and flow. But if you have the odds on your side, you can expect a positive outcome over time. Okay, now I'm going to talk about 4 simple steps successful traders know. And when I'm done here, hopefully all of you will as well. And for you, those of you that are successful traders, you will not be surprised at these. First is money management guidelines, selection criteria, entry and exit rules, and what I call high velocity turnover. And in a few minutes, I'm going to introduce Instant Profits to you, our trading course that embodies each of these 4 steps. They're simple, but they're very powerful.